We left off last time with the loanable funds. Different reasons why it's an important market to consider as it relates to economic growth, employment, and a number of different things. So we've got a few more details to go, and then we'll be moving into, excuse me? Attendance, it's passing around. Thank you. All right. What we haven't done yet is talked about shifters, how this thing moves around. So that's what we're going to start on today, is how the curves move. Our primary player in the supply of loanable funds was households that are going about their business saving some money. Some borrow money, but on average, they end up saving more money than they borrow. On the vertical axis, we're measuring the interest rate, but it's a special interest rate. It's the real rate of interest. So it's been adjusted for inflation. And the tool that we used last time was the approximation brought to us by Irving Fisher that said, hey, just take the nominal rate and subtract the inflation rate, and you've got about what the real rate of return is. That's going to be our inflation adjustment that we'll use for interest rates. We're measuring loanable funds, which just kind of reminds us that these are money that's kind of at play out in the market, available to be put to use. Who's putting it to use most likely and most of the time is, on average, businesses that borrow funds to buy tractors, machines, computers, all kinds of things for their business. So all of the agents of the economy, households, businesses, and the government could be on either one of these, but we're kind of targeting which ones are in general in that position. Okay, so let's knock out each one here. The demand for loanable funds. So businesses desire more funds. Businesses desire more funds to increase investment. From our cigarettes, the investment we're talking about here is the purchase of these machinery and equipment and tools and buildings. Businesses desire more funds when it costs less to borrow. A decrease in the interest rate. The cost of borrowing is the rate of interest you're going to pay. Businesses desire more funds when it costs less to borrow. That is our downward sloping curve. That's why it looks the way it does. You decrease the interest rate, I'll borrow more money, right? So businesses desire more funds when it costs less to do so, given expected profits. This is our ceteris paribus assumption. But we're being a little more specific. We're saying, hey, they're thinking about the future. What would cause me to borrow today money that I know I have to pay back in the future? Well, I'm expecting that I'm going to have some profit to pay it back, right? So an important consideration for businesses is their expected profits. All right, supply. The supply of loanable funds. The SLF. All right. The lower the real interest rate is, the lower r, little r, is, the lower is the opportunity cost. The lower is the opportunity cost of consumption. From our cigarettes, that's the C. And therefore, we consume more and save less. I want you to get that down, and then we're going to dissect that a little bit. The lower R is, the lower the real interest rate is, the lower is the opportunity cost of consumption, and therefore we consume more and save less. So we're tying back now the thought of interest rates and consumption today, or on the flip side, savings. So I use the word consumption even though we're looking at the savings behavior. I'm trying to describe why this thing's upward sloping. Why do we save less when the interest rates fall? And so you might say, well, it's because you're not getting as good of a return on your money. True. That's not untrue, but I'm kind of talking about something different here. All of a sudden I throw consumption and I say, well, the opportunity cost of consumption, the economist says, of course, that's lower, so we're going to do more. So why is the opportunity cost of consumption lower? That's kind of an unusual statement, I think. A little different. Us economists think a little differently. What is the cost of consumption? What is the cost of consumption? The opportunity cost of consumption. Money you could have saved, right? So we could characterize that my opportunity cost of doing this Mountain Dew is that I couldn't have a Diet Pepsi, right? So my next best alternative was another form of consumption. But if that's not bringing into the reasoning the time period thing, right? So if I delay consumption today, whether it's soda or other things, I'm giving up future consumption. I could have saved my $100 and had $110, as the example we went through last time, to buy cheeseburgers in the future, right? So my cost of consuming today was 4.76 cheeseburgers that I could have had tomorrow. See what I'm saying? So we came up with the opportunity cost, the real interest rate last time, in terms of purchasing power was 4.76 hamburgers, which means I can think now about my consumption today being the cost of what I could be consuming tomorrow, what I gave up tomorrow to do today. All right, so let me tack on a little recall. Our disposable income, our income after tax, is partitioned into consumption and savings. If we think of it that way, a fixed amount of money is either going to be consumed today or saved today. That's all we're allowing the consumer to do. And I'm going to add on one more little level of detail today to this, is to say, what is the fraction of my income I'm going to save? So imagine I've got some percent. The example I went through on the overhead was 90%. So 90% of my income I'm going to devote towards consumption, plus the remaining 10% is going to go towards savings. So I got 100 bucks. I consume 90% of it, 90 bucks. I save 10%. So I put on some equation goggles here and came up with this little statement. And we've got some words for this percentage. This is called the marginal propensity to consume, the MPC. And this is the marginal propensity to save, the MPS. So the marginal propensity to consume, the MPC, is simply the fraction of my disposable income that I put towards consumption. The fraction of disposable income, YD, Y subscript D, the fraction of disposable income that goes to consumption. The marginal propensity to save, the MPS, is the fraction of income that goes towards savings. Is saving in this context a flow or a stock? Is savings a flow variable or a stock variable in this case? So I made $100 of income. I'm partitioning my income into Twinkies and beer and some towards tomorrow's Twinkies and beer, future consumption and current consumption. Is saving a stock variable or flow variable? We had the little wealth discussion last time, so we had a little bucket, we had a little faucet. Stock or flow? Stock? Stock variable has meaning at a point in time or over the period of a time? Stock variable is at a point in time. So what is my savings today? Whereas I might say, what was my savings over the course of 2013? The way I'm describing it here is saving, the variable saving, a flow variable over a time frame like 2013, or a stock variable? It's a flow. Good. So it ties back to the income, is one way to think about it. Remember we talked about, if I told you I make 130,000, am I rich or poor? And you said, oh, you're rich. And I said, no, you're not. Not if I made it over 10 years. Right? If I made 130,000 over 10-year time frame, I'm poverty. I'm right at the poverty level. So this is a flow variable, which means these are then decisions of flows over the course of time. So in this context here, the savings is a choice we're making to defer consumption today. All right, questions or comments on that? All of this was just simply describing, hey, interest rates go down, I don't save as much. Interest rates go up, now all of a sudden today's consumption isn't very attractive. If I can get a big rate of return, I'll save it rather than take on another slice of pizza today. Okay, shifters. What causes these puppies to move around? For businesses that are attempting to maximize profits, it is those expected profits that we held constant in the definition. They are going to be the shifters. So let's just call SLF shifters. The reason I like to highlight these for you, the way I do, it's a little different than the book. It's not different in terms of what they are, but just kind of put them right in your face. is you should have these memorized for the next test. Just memorize, it's just a list. This one's only going to have one. So memorize that expected profits is a shifter of the, whoops, this is a DLF, sorry. This is our businesses here. Expected profits is a demand shifter. So if there's an increase in expected profits, how is this curve or line, this SLF curve, going to move? Is it going to move this direction or this direction? If, oops, gosh darn it, I keep going up to supply for some reason. My brain is not working. This curve, the DLF curve, is it going to move this direction or this direction? If businesses expect that 2014, 2013 is looking good, shift to the right or to the left? To the right. Good. So as expected profits rise, that's going to lead to an increase in the demand for loanable funds, a shift to the right. Now you can see the competition starting to kick in. As more and more firms want to borrow funds, there's only so many funds out there. That's going to put upward pressure on the interest rate. So interest rates are going to rise from this. So you might put a little extra note, since we did it this way. This would cause an increase in the real rate of interest and an increase in the quantity of loanable funds. I don't know if I want, let's put QLF there. The quantity of loanable funds, the quantity of dollars being traded. As we move this way, I'll just put a little dashed line in here. We would go to a higher interest rate. Interest rates would move from R1 to R2, maybe from 5% to 6%, if we want to just make up some numbers to tell a nice little story. And the quantity of loanable funds would move from Q1 to Q2. Now the indirect effect I want to come back to, if there's more funds being borrowed, what's happening to our capital bucket? It's going bigger, right? So the capital bucket is our stock variable. And so the more purchases we're making through borrowing, the more investment is going on. It's starting to fill up the bucket. All right. So let's put that as an extra note here. An increase in the quantity of loanable funds means there's an increase in investment, which ultimately means the accumulation of machines. Put a little reminder, here's the flow. More flow in 2013 means more machines to work with in the future. The stock of capital rises. All right, so another extra note here is to remember the business cycle. So expected profits is also linked to the business cycle. Business cycle, business cycle. Russ, I thought we did, that was chapter 4 material or 5 material. We don't have to know that anymore. That was test 1. Wrong. Business cycle, what is it? Business cycle. What's moving? What's cycling? GDP. What type of GDP more specifically? Real GDP, right? The real economic activity that's had inflation filtered out of it. And so we're measuring real GDP on the vertical axis, and what's on the horizontal? Time. Just measuring time. And that's that ups and downs of the economy. So as the economy starts to go through an expansionary phase, people are probably expecting higher profits. If we fall into recession, people have kind of a bleak outlook on the future, then expected profits are falling. So those two things are positively related to each other. So positive relation of expected profits and real GDP. Positive relationship again, real GDP is going up, expected profits are going up. Right? They move together. Real GDP is falling, we fall into a recession, people are a little down on the outlook, expected profits are falling. Right? So expectations play an important role that we're going to spend a lot of time in future chapters. That's why I wanted to touch on it here, make sure we bring it up. All right, questions or comments on that? All right, so just one shifter for the demand curve. The supply curve, we're going to have a few. So the SLF shifters, supply of loanable funds, that's our households. And one of the things that's going to increase their savings comes to us from that little formula we just did with consumption and savings, if they have more disposable income. So disposable income is a shifter. If people are having more money, they are going to save more. A shift to the right. Holding all of the things else constant. Now that's not the only thing they're going to do. If your income goes up, are you going to enjoy some Twinkies and beer and pizza today too? Yeah, so both are going to go up, right? So if your disposable income goes up, again, we put our equation goggles on, more income, I'm going to spend a fraction of that income on today's junk as well as my future junk through savings. Okay, so both going to work together that way. All right, wealth. We have a wealth effect, which is different than income. So wealth is looking at the purchasing power of what we're going to call net assets, which is really net worth. Last time we looked at, on the overhead, one of your pictures here, the wealth of our nation over time. As we move through time, we can think about the wealth of our nation, the value of your assets, what you own, minus what you owe, your liabilities, gives you your net worth or your wealth. So what happens with the purchasing power of that net asset? So first of all, wealth or net assets, which let's put in parentheses here, wealth. Net assets are equal to the assets, value of stuff we own, minus the value of stuff we owe. Assets minus liabilities for you accountants, but I don't tend to think that way. Value of stuff we owe, our debts. So we got some ownership of some stuff, but we may owe some people some stuff. The difference gives us our wealth or net assets. Okay, so the wealthier we are, the more we'll tend to save. But we got a special thing to kind of point out here. So, first of all, let me just say an increase in wealth leads to an increase in supply of loanable funds. And we also have to think about inflation. So let me just put out here, watch out for inflation. An increase in the price level leads to a decrease in our real wealth. Similar to what we saw with the purchasing power of our wage and other things that we factor inflation in for. If I'm worth $1 million, I'm a millionaire. I did this little calculation and I own more crap than I owe to the difference where it's $1 million. That's what we call a millionaire when we refer to a millionaire. You don't need $1 million in the bank. You don't need $1 million worth of $100 bills stacked up in cash. You just need this equation to equal 1 million to be a millionaire. But if you stay at $1 million from 2013 to 2033, but over that 20-year time frame, the prices on the stuff at Walmart went up, does your $1 million buy as much as it used to? No. So your wealth has gone down. Your real wealth has gone down due to inflation. And that could cause you to change your savings behavior by increasing some savings to offset that. Okay, lastly, number 3 is our expected future income. Expected future income. So I'm going to put our Y that we've been using, capital Y for income. This time I'm going to put a little superscript E for expected future income. Now, college kids are great at this. I know I was great at it when I was your age. If you got more expected future income because of what you think you're going to land for a job once you get out of here, do you tend to consume more today or less today? More. More consumption today means less savings, right? So in terms of its effects here on the supply of loanable funds, an increase in expected future income leads to a decrease in the supply of loanable funds. So us as a nation are guilty of this too. When things were going good through the expansionary phase of the 2000s, and everybody thought they couldn't lose money and the economy's so awesome, we all thought our expected future income was going to be higher. And so not enough people saved. They started to decrease the supply of loanable funds on a personal household level. But China didn't think that way. They were pretty darn good savers. So to bring this back now to the bigger picture, as China started to buy up our financial assets, in other words, China's increase in savings helped feed our lack of it. And so those two effects kind of battled each other through the 2000s. And in fact, the savers around the world kind of won out. And so while Americans continued to decrease their savings, we were kind of bailed out by the rest of the world so that we didn't see higher interest rates because of it. Interest rates continued to be low because places like China were increasing savings. They're way better savers than us. Way, 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 way better. That's part of why they're seeing a lot of prosperity now relative to us too. So there's some effects thinking around the globe that we're going to talk about next. That was one of them, just to kind of feed into this last thought before we move that direction. Okay. Questions or comments on that? All right. I guess I want to put the other players in there as kind of special notes. Let me get rid of this too. So last time we used an equation that captured our level of investment, and we said it came from private savings, U.S. households, plus government savings, U.S. government, if we're talking about the United States, domestic government savings, plus the rest of the world savings. All right, so this is domestic U.S. savings, USA domestic savings. And so we had our savings plus taxes minus government spending. If by chance the government collected more taxes in a given year than what they spent, this would be a positive number, although we've learned already it's normally negative. They're a net borrower. Plus, the rest of the world savings is the one I was just talking about. If we take our imports minus our exports, our trade deficit leads to money flowing into the United States in the form of savings. So the rest of the world's savings, government savings, private savings, all of that leads to part of the equation here on how many funds are getting traded over a given time frame. All right, so how do we get those pieces? So we got a couple other players. So let's call this the shifters for the other players. Let's start off with the rest of the world. So with the rest of the world, a trade deficit in the United States, a trade deficit leads to an increase in the supply of loanable funds. If we allow them into our island to be part of our system, if we let outsiders in, that would be the effect of a trade deficit. Number two is the government. All right, and our government deficit, so our national deficit in the USA leads to an increase in the demand for loanable funds. Notice I shift to the demand curve, not the supply curve. That's why I call these are kind of special shifters for other cases. Now, had the United States government been supplying funds, it would be this. But now they're competing for funds because in order to pay for their weapons of mass destruction, they need to do some borrowing. So now all of a sudden they're in the demand side of life. Okay, so how does that play out? So this is the effects of the deficit. So let's title this Deficit Effects. I want to start off thinking about the United States without any government deficits. We have a balanced budget. Good luck on that one. I don't think we're going to see that for a while. We might see a surplus, but very rarely that we're going to have a deficit. And by the way, I'm not anti-deficit or debt. It's just that they're supposed to balance each other. Like some years you run a surplus, some years you run a deficit. Over the long haul, they kind of wash out with each other. That's the way it's supposed to work. So this 30 to 40 year deficit pattern is what's troubling about today's financial markets and how they relate to the government. All right, so I want you to think about these curves being kind of a balanced budget, no government. So think of these being the private sector. So let's put a little PVT. I think the textbook, I don't have that handy to look, but I think they called this the private demand for loanable funds. So it's basically same notation, PLDF. So with a balanced budget scenario, we would have some interest rate and some quantity of loanable funds, some amount of investment. Let's just say we'd be operating at 3%, just to pick a number out of thin air. So there's kind of the free market with just businesses and households because the government has a balanced budget. And we'll ignore the rest of the world right now. A deficit then leads to what happening? I gave this to you already. Increase in demand, good. So that's this part here. So this demand curve is going to kind of shift to the right now that the government is an added player to the marketplace, right? So if we draw a new demand curve, let's call this the demand curve with a deficit. So the government's involved in the private market. So we got both the private sector and the government in there. All right, so what happens? What's your prediction from what we've done so far? Got to start using our tool. An increase or decrease in what? Increase in interest rates, good. And a quantity, okay. So quantity goes up to Q2. Interest rates rise to, let's just say, 4%. Well, that seems kind of good, right? More funds being exchanged, isn't that going to lead to more of the bucket being filled up with capital? You know, isn't this a good story? Well, we need to dissect it a little bit further. This quantity is now a mix of government and private agents, right? As interest rates started to go up, did businesses borrow more money or less money? Did businesses borrow more money or less money? Less, right? That's what we learned earlier. Interest rates go up, they're going to buy less. So this demand curve is still relevant. It's still capturing business behavior. As interest rates started to rise, businesses started to borrow less. So the amount of funds that are going into private business, let's call PVT down here, at 4%, they're doing less than what they did before. And so now we've dissected how much of this is private borrowing, how much of this is government borrowing. And so this horizontal distance here is the amount of the deficit. That's how many dollars were borrowed to pay for those extra weapons of mass destruction that would otherwise not have gotten funded, right? That's the amount of borrowing that went on, the deficit. So, good or bad for the economy? Good or bad for the bucket of K? Bad. Why? Okay, businesses are the ones with this flow. They're the ones cutting back on purchases of machinery and buildings and tools and stuff that helps make other stuff. So they've actually reduced some private investment. So the private sector got crowded out of the market to some degree because of the deficit. So this is what we call crowding out. Now, good or bad is kind of a loaded question. I want to challenge you on this now. So there was some money that the government borrowed. Good or bad? Loaded question. I'll just tell you. The answer is depends. I want you to think about depends on what? Okay, it does depend on that. So in the future, they're going to need to pay it back. Maybe think in terms of this terms. I just got done saying that businesses were buying less machines, less computers, less tools. So if they're investing in capital, good. So that's a big if, though, isn't it? What is the government spending these borrowed funds on? That's the key to the question. During this campaign and past campaigns, how many times did you hear President Obama, well, we got to get roads and bridges and shovel-ready projects and blah, blah, blah. That is good, and in fact, I think, my opinion is that out of the Great Depression, the New Deal, where we did build roads, bridges, dams, put people to work, blah, 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 we did a lot of that. That made for, is the Hoover Dam still there today? Yeah. How many years later? A lot. I don't know when it was exactly, but we're talking 60, 70 years later at least, right? So those projects persisted. You remember when I was talking about the tractor? We saw the old tractor out in the pasture and it might be 40 years old. If the government spends those funds on something that's going to persist, it could have some positive effects. But if the government spends it on something that's not persisting, then it might not. So one of the key questions with all of this always comes down to is, what is the money being spent on? So the devil in the details when it comes to things that the government's talking about right now is what's in G. What's in there? What are you spending G on? We kind of throw G around all the time. And does that make it appropriate to do across-the-board cuts with G? No, not really. Is this going towards more paper toilet paper at the White House? Is it going towards some weapons of mass destruction in our already huge inventory of bullets? Is it going towards a road? Or worse yet, this was one that came up a lot during the recession, did we actually tear up a road to put a new road down? That's a waste of resources. We go back to my little hole in the bucket. We go and destroy something that's productive in order so that we can spend money on something else. That's where things get a little murky in the political arena, right? They're not following solid economics. What are we spending this money on is a key question that I hope every politician and every American is looking at closely as we try to figure out these issues related to deficits and debt. All right, so we got to write down here crowding out. This is a big one. So crowding out is the decrease in private investment. A decrease in private investment. Remember, when we use the word private, we're thinking about those private companies. A decrease in private investment due to a deficit. Due to a government deficit. Essentially, the government is crowding out business investment. There's an increase in the interest rates, which leads to a decrease in private investment. That's the crowding out phenomenon. And that's what we're seeing here with this picture. Now, one last thing that I'll cover next time. If you are a private person living in the United States and the government's been running persistent deficits, and you know that ultimately you understand that equation of T and G, what's going to happen to your future T, your future taxes? They're going to go up. What might a smart, wise person do today because they're now facing future tax liability? Save. Increase savings. We'll pick it up there next time.